Today we are going to be looking at weighted average cost of capital. That's the main discussion for today. All right. Weighted average cost of capital. WACC. You will recall that when we started this class about 2-3 weeks ago, all right, I mentioned to you that there are 3 categories of cost of capital. One is traditional weighted average cost of capital. 2, project-specific cost of capital. Then 3, WACC of the combined activities. Then we started with traditional weighted average cost of capital. Specifically, I mentioned to you that whenever you want to compute traditional WACC, there are 4 procedures you are expected to follow. Step 1 is to calculate cost of equity. Step 2, determine cost of preference share. Step 3, you compute cost of debt. And finally, step 4, you estimate weighted average cost of capital. From the day 1 for this topic, this is going to be the 4th class on cost of capital. So we have completed discussion on cost of equity, cost of preference share, and last week we dissected cost of debt, including cost of convertible securities. So today we are going to be having weighted average cost of capital. Therefore, what do you understand by WACC? Please open to the material at your hand. You already have it. So let me talk through the working notes while you open to your material. So what do you understand by WACC? You can simply put WACC represents the overall rate of return for a firm. It is the average cost weighted according to the proportion, or you can say is the average cost of each source of finance weighted according to the proportion of the companies in the company's total pool of capital. Let me put it down. So I say WACC represents the overall required rate of return. Okay, required rate of return for a firm or for a company. Okay. It is the average cost of each source of finance weighted according to the proportion. Okay. Please, everyone, mute. Sanusi Yusuf, Chioma, Pinozo, everybody, please kindly mute. Weighted according to the proportion of capital according to the proportion of the company's total pool of capital. Okay. All right. So that is what weighted average cost of capital is all about. Let me explain further. Let's say, for example, in an ideal capital structure, I mentioned that there are three key major sources of long-term financing. We have ordinary share capital, preference share capital. We also have debt capital. These are major sources of long-term financing for a firm. Each source of finance has its own underlying cost. So in this capital structure, the cost associated with ordinary share capital is what we know as cost of equity. Cost associated with preference share capital is KP, cost of preference share. The cost associated with debt is known as the cost of debt. So each source of finance in the capital structure has its own underlying cost. So what we are now saying is that when it comes to WACC, the average of the major sources of finance open to that firm, weighted according to the proportion of the company's total pool of capital, is what we call WACC. It's not that you are just going to add together cost of equity plus cost of preference share plus cost of debt divided by 3. No, that is not the average we are talking about. You are expected to weight each cost of capital, each cost of capital according to the proportion in the company's total pool of capital. Say, for example, this ordinary share capital, hypothetically, let's say we have 1,000 naira ordinary share capital. We also have preference share capital of, say, for example, 200. We have debt of 300. The company's total pool of capital is 1,500, right? This is the total pool of capital. Let's say, for example, let me write this. Capital. So let's say, for example, the cost of individual source of finance, all right? The cost of individual source of finance, say, for example, this one is 15%. Preference share capital is 10%. Then debt is 12% for simplicity. Right. So when you now talk about WACC, what we are saying is that first thing first, you need to take the proportion of equity. What is the ratio of equity in the company's total pool of capital? To do this, I need to divide the 1,000 for equity. The proportion of equity, it will be the 1,000 divided by the total value. I will then multiply that with the cost of ordinary share. Okay, cost of equity. So in this case, I can say for ordinary share capital, proportion of ordinary share capital is 1,000 divided by 1,500. Then to now get the average of that, I need to multiply with the 15%. Whatever I have, I put it there. Let's say, for example, this is not the exact figure, but I'm just for simplicity. Let's say, of course, preference share capital is 200 divided by 1,500, then multiply by the cost of preference share, which is 10%. Let's say this one will give us like 4%, okay? Then finally, the debts. The proportion of the debt is 300 divided by the total capital of 1,500, then multiply by 12%. Let's say on the average, let's say, for example, when you use your calculator to get it, then you have about 6%. So You now add all these three together. So that means the WACC of this company is 20%. That's the weighted average cost of capital. So now that's why you are seeing from my definition, I said that it represents the average cost of each source of finance. Source of finance is ordinary share capital, preference share capital, and debt proportion. So that is what WACC is all about. All right. This is just for explanation purpose. You don't need it for anything, just for me to explain further what I mean by that definition. All right, so let's move on. Estimating WACC. Let's talk about how to estimate WACC. Okay. Basically, of course, I've told you when we started in the first lecture day, I mentioned to you that there are three different methods of calculating WACC. One is traditional WACC, okay? Two is project-specific WACC, and three is WACOCA, that is weighted average cost of capital of the combined activities. Now, what we are doing currently is traditional WACC. So in estimating the traditional WACC, I gave you the procedures you are expected to follow. We have done all of that. However, when you now want to calculate the WACC, you can either use, if you want to calculate the traditional WACC, you can either use market value method or you use book value method. Let's put it down. The WACC can be estimated using either book value or market value method. All right. So in doing this, of course, in most cases, examiner will not tell you whether you should use book value or you should use market value. But what is important is that you need to know how to express yourself with either of the two. All right. So let's talk about each of them before I give you the formula. All right. Okay. Let's start with the book value. Now, when you talk about book value, it simply means the figures you have in the balance sheet. All right. That figure that you have in the balance sheet is your book value. Depending on what you want to calculate, you can also say it's a face value. All right. It's a nominal value. All right. So it's the par value, whatever you have in your balance sheet, the figure you have in that balance sheet is your book value. All right. So when calculating WACC using the book value, ordinary share capital and reserves must be added together to form the proportion of equity. Let me put it down for you. This represents the figures stated in the balance sheets. In the balance sheet or statement of financial position of a firm or of a company. So when calculating WACC, the ordinary share capital and reserves must be added together. Okay, must be added together to form the proportion of equity. To form the proportion of equity. In the company's total pool of capital. Okay. All right. So what we are seeing here is that, let's say, for example, like I mentioned previously, let me rewrite it. Let's say, for example, you have ordinary share capital of 1,000. You have reserves of 500. You have preference share capital of 400. Then you have debts of 600. So when you add everything together, this will give us like 2,500. This is the total. So when I'm calculating WACC and I'm using book, examiner is asking me to use book value. So you're expected to add together ordinary share capital and reserve to form the proportion of equity. So in this case, ordinary share of 1,000, ordinary share capital of 1,000 plus reserve of 500 will give us 1,500. So these two will form the proportion of equity. All right. This will form the proportion of equity. So when I now want to calculate my WACC, if I want to determine the proportion of equity, I would then say equity value would then be equal to proportion of equity will be 1,500 divided by 2.5. I will multiply with the cost of equity. Proportion of preference share will be equal to 400 divided by 2.5 multiplied by cost of preference share. Proportion of debt will be equal to 600 divided by 2.5 multiplied by cost of debt. So what this simply means is that the bottom line is that whenever you want to calculate WACC using book value, all right, you are expected to add together ordinary share capital and reserves to form the proportion of equity. All right, so that's what I've explained here. So note that. Now, you can only use book value to calculate or to calculate weighted average cost of capital if examiner is specific, if you are required to do so. Otherwise, you are expected to use market value because market value is more realistic relative to book value. So it is only when you are asked on the day of your exam to use book value, that's when you are going to use it. But in most cases, examiner will be silent. So you should know it is implied in the question that you are supposed to use market value. All right, so let's talk about market value. Market value method. What's wrong? Okay. Now, what do you mean by market value? Of course, market value is the same. You can call it market value or market price. All right. It represents the price determined by the market forces of demand and supply. So in the calculation of weighted average cost of capital, the market value should be used. All right, because market value represents or reflects the current market condition in the capital market, represent the current market condition. All right. So, of course, when you talk about price determined by the interaction of demand and supply, the buyers and sellers, All right. So the current information is already embedded in the market price, unlike the book value, historical value. All right. So, and that's why market value will always be higher than when you calculate weighted average cost of capital using market value method. Of course, it will always be higher than the book value, because it's like book value is static, is static. All right. Because what you have in the balance sheet, it could be for several years, it will still be there. Provided the number has not changed, it will still be the same thing. But market value, it changes as depending on the prevailing market condition. All right. So let me put it down for you. The market value represents the price or the value determined by the market forces of demand and supply. Okay. The market value should be used to calculate WACC. Always, except examiner says otherwise. All right. This is because the market value reflects, the market value usually reflects the prevailing market condition. Okay. Reflect the prevailing market condition and is more realistic relative to the book value. So I've already told you, whenever you want to calculate WACC, you should always use market value. Now, what do I mean by use market value or use book value? The essence of this is to form the proportion. You are using market value or book value to form the proportion of equity, preferential, and debt. So what we are now saying is that as far as market value is concerned, instead of you to use book value to form the proportion, use what is determined by the market forces of demand and supply. All right. So because that value is more realistic and it is current. Okay. So how do you then estimate market value? Because I told you when we had cost of equity, cost of preferential, and all of that, I said that when we get to WACC, I will give you the formula to calculate market value. All right, so let's talk about how to estimate market value. Calculating market value. Okay. So starting from equity, market value of equity, denoted as E. The market value of equity will be computed as, I will give you two different formulas. One, if in the question you are given number of shares, then market value will be equal to number of shares, number of ordinary shares multiplied by xdiv share price. Okay, xdiv share price. So this is one formula of calculating market value of equity, or equity value equal to, if in the question you are not given number of shares, then you can use share capital to get your number of shares. Therefore, I can also calculate equity value as share capital divided by the nominal value. Nominal value per share. The nominal value is the same thing as face value, book value, per share, or par value. All right. So multiply by xdiv, x dividend, share price. All right. So as you can see here that you have xdiv share price. All those concepts I explained when we had cost of equity, you have to apply it, because when you are calculating your WACC, you are expected to use xdiv. Sorry, when you are calculating market value of equity, you are expected to multiply number of shares with the xdiv share price. So what it simply means is that if the dividend has not been paid, that means you need to convert. That means that share price is cum int. I mean, is cum div. So you cannot use cum div to calculate the market value. It has to be xdiv share price. So all those concepts, you need to apply it here also. So this is how to calculate market value of equity. Then let's talk about market value of preference share. Of course, the market value of preference share is the same thing, is the same formula as the market value of equity. Market value of preference share okay, denoted as P. So P equal to number of shares. Here we are referring to preference shares. Number of shares multiplied by xdiv share price. Again, in case you don't have number of shares, you can also use share capital to get number of shares. Please, it has to be issued share capital. You don't use authorized share capital. It must be issued share capital. So divided by the nominal value multiplied by xdiv, x dividend, share price. So these are the formulas also that you can use to calculate market value of preference share. So the last one, debt value. How do you estimate debt value? Market value of debts, denoted as D. To calculate debt value, you take the nominal value. So like I said, nominal value is the same thing as book value. All right. So the figure, nominal value is the figure you have in the balance sheet. So multiply by X int price, X interest price, divided by 100 naira per unit of the debt. Except examiner says otherwise. If you are told in the question that the debt is quoted at 1,000 naira, then it is 1,000 you are going to use. But in most cases, it's assumed that debt is quoted at 100 naira per unit. Okay? Now, again here, you have to apply the concept of xdiv and then cum div, meaning that you need, x int and cum int. So here you need you need S int price to calculate the market value of the debt. So which means that if cum int price is given to you, you must convert it to X int price before you calculate the market value. So these are the formulas that you can use to calculate market value of equity. So before you begin to calculate your WACC, you need to go and do your workings. All right, you need to go and calculate the market value of each of them, depending on the capital structure. Because at times, examiner may just give 2 out of the 3. You may have equity and debt. In some instances, you are not going to have preference share. But if you have the 3, then you have to apply, you have to work for the 3. So let me give you the formula for calculating WACC. So now that you know how to calculate market value of each source of finance in the capital structure, then let me show you the formula you're expected to use to calculate your WACC. All right. So calculating WACC. Denoted as KW. The formula below can be used to estimate weighted average cost of capital, to estimate WACC. Okay. To get the WACC equal to equity value divided by total value, value of equity plus value of preference share plus value of debt. All of this multiplied by cost of equity plus value of preference share over total value, that is equity value plus preference share plus value of the debt value multiplied by cost of preference share plus debt value divided by total value, equity plus preference plus debt. All of this multiplied by after tax cost of debt. That's it. This is the formula for calculating weighted average cost of capital. Like I said earlier, in most cases, the middle guy, which is cost of preference share, this preference share may not be there. It will just be between equity and debt. But if you have the 3, this is extended formula. Let me give it to you. Alternatively, using tabular method. Yes, somebody is sending me charts. So my line is breaking. Really? Okay. Let me see. Maybe I need to change my network there. So let's continue. I will use. Oh, okay. I want to switch to another network. No worries. So to use the tabular method, depending on the capital structure, oh, sorry about that. Okay. So preference share, then we can have debts. Okay. Then we create another column. We create another column for value. So this value, it could be market value or book value, whatever it is, put it there, put the value there. Then you get the total value. Okay. Then we can have the cost of individual capital, or you call it proportion. The cost of individual capital. Then you have ash total. Let me rewrite it. All right. So the proportion of individual capital, what I simply mean by cost of capital is that, of course, you have already calculated your cost of equity. Whatever you have as your cost of equity, put it there in percentage. All right. So this is cost of equity. For example, KE, here is KP, here is KD. Whatever you have calculated as cost of equity, cost of preference, and cost of debt. So in percentage, put it there. Then to now get your ash total, you are expected to multiply together. The value, you multiply the value with the proportion. Let's say, for example, cost of equity is 10%. So I will just say I will say whatever you have as your value. Let's say you have 1,000 here. This one is 10%. This is 0.10. Therefore, 1,000 multiplied by 0.10, that will give me 100. I'll put 100 here. All right. So that is how you are going to get your ash total. Put this here, then you add everything together. So after this, just go ahead and calculate your work. Therefore, work will be calculated as ash total so ash total divided by total value. Multiply by 100 over 1. So whether I use this tabular method or I use the formula, I'm expected to get the same answer as my work. All right, I'm expected to get the same answer as my work. So that is how to calculate the weighted average cost of capital. Okay, let's move on. At this point, we can have example. The key thing that you need to know in calculating work, I've already explained to you. And so at this point, let's have illustration. Let me know if you have any question for me before we dive into calculation. Timileyin, go ahead.
Okay, sir. So in
Timileyin, you raise hand. Go ahead.
the second illustration, in the second formula, I didn't really see how it took care of the tax elements.
In the formula, right?
Yes, I just wanted you to just help me brush up on that.
In this one?
No, in the second one.
In this formula?
In the tabular one.
This one?
In the tabular one, yeah.
Okay, you would have already, you would have already incorporated tax. When you are calculating your cost of debt, you would have adjusted for tax.
Okay.
So you know when you are calculating cost of debt, ordinarily you are supposed to adjust for tax, right? You know, in the interest, let me put it down. In the interest, when you are calculating the post-tax interest, you would have adjusted for tax. You know, you use the coupon rate, the interest rate. We said that debt has tax deductibility benefit as a tax relief or tax benefit associated with financing with debt. So the company will pay a cheaper cost, right, relative to when there is no tax. So in this case, you would have adjusted for tax when you are calculating the cost of debt, 1 minus tax. Okay, this is the formula for calculating after tax interest. So when you are calculating your KD, whether it's redeemable or irredeemable debt, you would have adjusted for tax. So when you have adjusted for tax, then there is no need for you, even in this one, using this formula, there's no need for you to come and say 1 minus t again, because that will be double dipping. That means you are treating tax twice. All right. So before you get to this stage, you would have adjusted for your tax. All right. Even when you are calculating the market value of the debt, for example, here we said X inch price. All right. So you would have adjusted for tax before when you are calculating the cost of individual source of finance. All right. So you see what I'm talking about by the time we begin to solve questions. Okay. Similarly.
Yes, sir, that's fine.
All right. So let's move on. Let's have illustration. Let's have illustration. While we are doing that, let me quickly switch my network so that we have a more stable network to use. Okay. Please give me one. Thank you. I appreciate. Yes. Let's start small. So from this moment on till we get to project specific, all what we are going to be doing are calculations. So I've explained all the relevant concepts. So let's start with this illustration number 11. I need somebody to read the account of Astra PLC. Illustration 11. One of you should read, please. I want to be sure you are following me. Yes, who is helping us to read? Let me even look at the class. Some of you have not talked since we started this class.
Okay.
Zoom user, let me start from you. You are the last person in the bottom. Zoom user, please read. Zoom user.
The account of Austria PLC reviews the following capital structure. 1 naira ordinary share at 2 million naira, reserve at 3 million, 10% debenture at 1 million. The market value of the above share is as follows. Ordinary share 3.73 naira x dividend. Debenture stock 80 naira. Stock of equity is estimated to be 20%. The cost of debt is 7% after tax. What is the weighted average cost of capital using I-M1, the book value, 2, market value?
All right, thank you, Zoom user.
That is all, sir.
All right, thank you. So, yes, when you look at the requirements, you are expected to calculate average cost of capital using book value, then 2, market value. Therefore, what are you supposed to do? You have to calculate weighted average cost of capital. So using book value, yes, somebody is asking question. Please, can someone reshare the material? Okay. So go to the group, the WhatsApp group. I'm very sure you will see the material there. Somebody would have sent it. All right. So using book value, I mentioned that when you are calculating WACC, you are expected to add together ordinary share capital plus reserves to form the proportion of equity. So without wasting more time, so that we can solve as many questions as possible, let me stop sharing this and move to the working notes. Open to the material at your hand so that we can follow together. All right. So illustration number 11. Solution to Illustration 11, page. What page is that? That should be page 40. Page 30. Page 30. Page 30. All right. The name of the company is Astra PLC. What do we want to do? We have to calculate WACC. Therefore, I would then say calculating WACC. Weighted average cost of capital, denoted as KW. So before I put down my formula, I need to go back to the question and check what is the nature of the capital structure. Do I have equity, preference share, and debt all put together? Whichever one I have is what I'm going to calculate for. So according to the question, we only have ordinary share capital and then debenture. There's no preference share. So if there's no preference share, then my formula to calculate WACC will then be equal to equity value divided by equity plus debt value multiplied by cost of equity plus debt value divided by equity plus debt multiplied by cost of debt 1 minus tax. All right. So this is the formula that we are going to use to calculate the WACC. Roman figure number 1, I would then say using book value. So like I explained, using book value, you are expected to add together. You are expected to add together ordinary share capital plus reserves to form the proportion of equity. Therefore, WACC will then be equal to, I need equity value, the book value of equity. I will then go to the balance sheet as given to me. In the capital structure of the company, ordinary share capital is 2 million naira. Reserves is 3 million naira. When you add the two together, that gives 5 million naira. So here will be 1 million, 2 plus 3, 2 plus 3 divided by the total value, which is 6. All right, all of this multiplied by cost of equity. The cost of equity given in the question is 20%. Okay, so multiply by 20% plus D is the debt value. So debt value is 1 million divided by total value of 6 million. All of this multiplied by after-tax cost of debt is 7.5%. So examiner has already adjusted for tax. So our KD is already after tax. So no need to minus 1 minus tax again. No need to minus tax again. So if that is the case, WACC is by 20% plus 1/6 multiplied by 7.5%. So from the left, bring out your calculator. I would then say 5/6. Let's do it together. 5/6 equal multiply by 20. Forget about the percentage by the side of 20. Just put 20. So this will give me 16.67. Here is 16.67% plus the other side. This will be 7.5 divided by 6. That's 1.25%. 1.25%. So when you add the two together, this should give us 16 plus 1. That's 17.67 plus 25. That should be 92. So 17.92%. So using book value, WACC is approximately 18%. Okay. So this is how to calculate weighted average cost of capital using book value. I repeat, when you are calculating WACC using book value, you are expected to add together ordinary share capital plus reserves to form the proportion of equity in the company's total pool of capital. And that's what we have done so far. All right. So if I want to use tabular method to get this, of course, using tabular method, I can say alternatively, let me see, yeah, this page should be sufficient. Okay, alternatively, so I can use tabular method to get the same thing using tabular method. So I will create a column for the type of securities, then book value, proportion, hash total. Okay, we have equity. Then we have, what's the percentage of the debenture? The percentage of debenture is 10%. That's the interest rate. So 10% debenture, then we are going to have total. All right. So because we are using book value, no adjustment is needed. You don't need to go and do any workings. So what I will just do, I will go to the balance sheet. Value of equity will be equal to 5 because I'm using book value. I will add together ordinary share capital plus reserves. That's 5 million. The book value of the debenture is 1 million. Total is 6. According to the question, the examiner has given us cost of equity to be 20%, cost of the debenture to be 7.5%, 0.075. So to now get the hash total, you multiply 5 multiplied by 0.2. That should give us 1. Then 1 multiplied by 0.075. This is 0.075. When you add the two together, this should be 1.075. Therefore, my WACC will be equal to hash total divided by total book value multiplied by 100 over 1 equal. Hash total is 1.075. Total book value is 6 million, all multiplied by 100%. So we should have the same thing as 17.92%, which is approximately 18%. Let's confirm. Okay. 1.075 divided by 6 equal multiplied by 100. Okay. So we have 17.92%. That's it. Whether you use whether you use a tabular method or formula, you are expected to have the same answer. All right. So, high, using market value. So because the book value is always straightforward, no adjustment is needed. And that's why the examiner don't usually ask you to calculate WACC using book value. So it is under the market value. Examiner will hide something for you. All right. So using market value is the same formula, right? So WACC will be equal to, I need equity value. I need equity value, market value of equity. So I need to go and calculate market value of equity. So let me see. Let me put my working here. Working number 1, market value. You recall that I mentioned earlier today that when you want to calculate WACC using market value, you need to first of all go ahead and calculate market value of individual source of finance. Then once you are done with that, then you can use it to form the proportion of equity, proportion of preference share, proportion of debt in the company total pool of capital. So in this case, of course, I would then say equity value denoted as E. Before I put down my formula, I will go back to the question. Am I given number of shares? No, we are not given number of shares, but we are given share capital. So in that case, I will say share capital divided by nominal value. Okay, multiplied by XDIV, share price. So E is equal to, share capital is 2 million. Please, when you are using market value to calculate WACC, you don't have you don't have reserves. It's only under book value that you had reserves. All right. So when you are using market value, you do not include reserves. Okay. So divided by the nominal value. According to the capital structure, I think nominal value is 1 naira. Let me check. Yes, 1 naira ordinary share. So here is 1 naira. Multiplied by XDIV share price is 3 naira 75 kobo. So no further adjustment is needed on that. It's already XDIV. Therefore, what do you have here? 2 million multiplied by 3.75. 2 million multiplied by 3.75.
7.
Thank you. 7.5 million.
5.
Okay. So that's how to calculate market value of equity. Then let's calculate market value of the debenture, which is the nominal value multiplied by X int price divided by 100 naira. All right. So I will then go to the capital structure, to the balance sheets. The nominal value of the debenture is 1 million naira. All right. The exchange price given to us is 80 naira divided by 100 naira. So again, this will give us 800,000. So I need the total market value. Total market value. Value of equity plus value of debt. All right. So this should be equal to 8,300,000. Okay, so that's the total market value. So with this, I can then go up there and complete my calculation. Equity value is 7,500,000. Total market value of equity and debt is 8,300,000. So instead of me to come here under the denominator to say 7.5 plus 800, it's a waste of time. I've already added it together. Then multiply by cost of equity of 20%. I keep this on one side plus, open a bracket, the market value of the debenture, which is 800,000, divided by the total market value of 8,300,000 multiplied by after-tax cost of debt of 7.5%. Okay, so what will then be equal to, bring out your calculator, let's do it together. 7.5 divided by 8.3 equal, multiply by 20 equal, that's 18.07. Here is 18.07% plus the right side, 800 divided by 8,300 equal, multiply by 7.5 equal 0.72. Here is 0.72%. So add the two together. This will give us 18.79%. 18.79%. That means the WACC is approximately 19%. So this is how to calculate weighted average cost of capital using market value. Of course, this particular question is straightforward because of the fact that examiner has already calculated cost of equity and cost of debt. In fact, even the market price of the ordinary shares has been adjusted. You are given XD share price. You're also given X inch price. So in this case, it's more straightforward. But in most cases, especially at this your level, it won't be like that. You'll be the one to estimate those things. All right. So let's have another illustrations. We should be able to do like 3. All right. Well, let me know if you have any question for me before I switch to the question. Yeah. Yeah, Mr. At least mute. Okay. So let me stop sharing this and move to the study material. All right, let's have another illustration. Okay. Let's have this illustration about 13 to explain some concepts. Yes, who is helping us to read? Augusta, you are welcome. Can you help us read? Augusta.
Okay, sir. Can you hear me, sir?
Yeah, good evening. How are you?
The
Go ahead.
following figures have been extracted from the most recent account of Equity PLC balance sheet as at 30th June 2016. We have non-current assets for 10,000.
Yeah, so you can leave the figure in the table.
Okay, sir. Then
No.
ordinary share capital authorized 4 million shares at 1 naira each. Then going down. Okay. Then the current, that's 1st of July 2016 market value of Equity PLC ordinary shares is 3 naira 27 kobo per share kumbi. An annual dividend of 810,000 naira is due for payment shortly. The debentures are redeemable at par in 10 years time. Their current market value is 77.10%. Annual interest has just been paid on the debentures. There are no issues or redemptions of ordinary shares or debentures during the past 5 years. Then going down. The current rate of corporation tax is 30% required. Calculate the cost of capital which equity PLC should use as a discount rate when appraising new investment opportunities. Discuss any difficulties and uncertainties in your estimate.
Yeah, thank you very much, Augusta. Yes, that is the question. You can mute. Yeah, in the requirements, you are required to calculate the cost of capital which equity PLC should use as a discount rate when appraising new investment opportunities. So you want to calculate cost of capital. That is, you want to calculate WACC. Whenever you want to calculate WACC, first thing you need to ask yourself, what kind of WACC? Is it project-specific WACC? Is it WACC of the combined activities? Is it traditional weighted average cost of capital? You must understand from the question which one that you want to calculate. I've already explained to you that when you are given capital structural information, this is capital structure of equity. When you are given information, capital structural information, the way the company finances its operation, then, of course, you are also given the underlying cost, like you are given dividend, you are given share price, you are given interest and all of that, then in this case, you are supposed to use traditional work to calculate your traditional method to calculate your weighted average cost of capital. So without wasting more time, let's quickly see how we are going to solve this particular question. I will stop sharing. Okay. This is solution. So illustration, I think that's illustration number 13. Okay, 13, page 31. So the name of the company is Equity PLC. We're asked to calculate cost of capital. So to do this, I'll go to the balance sheet. I will go to the capital structure in the balance sheet to see how the company finances its operation. In the question, I can see ordinary share capital, which means I'm going to calculate cost of equity. In the question also, I can see 7% debenture. That means I need to calculate cost of debt. There's no preference share in this question. I don't need to calculate cost of preference share since I don't have it. So if that is the case, I would then say number one, that means I have 3 steps to calculate my WACC. I have 3 steps. Step 1 is to calculate cost of equity. Step 2, cost of debenture. Step 3, weighted average cost of capital. So let's take it one after the other. I want to calculate cost of equity. So I will say calculating cost of equity. You can see in the requirement, examiner only asks you to calculate cost of capital. You are not told to calculate cost of equity or cost of debenture. It's implied in the question. It's expected that you know what you are doing. So examiner did not tell you. All right. So to now calculate my cost of equity, which is denoted as KE, I need to ask myself, how am I going to calculate cost of equity? Am I using dividend valuation model? Am I using capital asset pricing model? Or am I expected to use Miller and Modigliani to get my cost of equity? Then I explained to you when we started, I said that cost of equity using dividend valuation model should be used when information on dividend and share price are given. So in this question of equity PLC, we are given dividend, we are also given share price. So which means that we are expected to use dividend valuation model to calculate cost of equity. And I said that using dividend valuation model, cost of equity represents the ratio of dividend to XD share price, depending on whether dividend will remain constant or dividend will grow. All right. So then if that is the case, before I put down my formula, because I already know from the question that I'm going to use dividend valuation model to calculate cost of equity. Since I'm given information on dividend, I'm also given information on share price. So before I put down my formula, I need to go back to the question whether dividend will remain constant to perpetuity or dividend will grow. So if dividend will grow, I will use a specific formula. If there is no growth in dividend payment, that means I will just use the ordinary regular formula. Whatever the case may be, let's go to the question and identify that. Okay, let's go and check. So when you look at the profit or information on the profit given to you in the second table, you will see that we are given information on dividends. All right. So from 2011 to 2015, you will notice that dividend has increased from 620,000 to 810,000. All right. So that means there's growth in dividend payments. There's growth in dividend payments. So with this information, I need to first of all go ahead and calculate growth rates. So I've identified from the question that dividend has grown. So if dividend has grown, examiner did not tell you that dividend has grown. You are the one that will determine from the question. So since the amount of dividend from 2011 to 2015 is not the same thing, it means that there is an increase. Dividend has increased from 620 to 810. So let's go and calculate growth rates. So I will do my working. This is for cost of equity, cost of debt, weighted average cost of capital. Let's say our workings will start from here. Okay. Working number one, we want to calculate our growth rates. So growth rates, which is G. Pay attention. Now, if you missed the first class when I was explaining the concept of cost of equity, this is an opportunity for you to recover. I told you that when you are calculating growth, there are two methods of calculating growth rates. I mentioned historical pattern of dividend payments, and I also mentioned the Gordon growth. I said that the historical pattern of dividend payments should be used to compute growth rates when the history of dividend payments are given. When you are given information on dividend paid across all relevant years, in that case, you are supposed to use averaging method, or what we call historical pattern of dividend payments, to calculate growth rates. So in this particular question of equity PLC, you will see that the history, the amount of dividend from 2011 to 2015 were given to you. So in that case, we are supposed to use historical pattern. So on the day of your exam, there is no point for you to say using historical pattern. Just go ahead, put down your formula, keep moving. Don't wait for anything. Keep moving. But if you put using historical pattern of dividend, well, it's no worries. Examiner will not penalize you, but it's just a waste of time. All right. So just put down the formula and move on. But for the purpose of the class, or for the purpose of this class, I will just give it to you. So I will say, since, just for your own understanding, since the history of dividend payments from 2011 to 2015 are given, the historical pattern, of dividend payment method will be used to calculate the growth rates. So like I said, don't go and be wasting time on the day of your exam by saying all of this. If you do it, no penalty, but it's a waste of time. I'm doing this for your own understanding. I want you to understand why we are doing it this way. That's why I have to write it out, not because of anything. But if you write it like this on the day of your exam, of course, that means you are demonstrating your capacity. You are demonstrating that you understand what you are doing. Yeah. Okay, so if that is the case, I would then say G equal to, now, you recall that I gave you two different formulas. The first formula, which is N minus 1 into square root latest dividend divided by dividend paid in the first year, all minus 1. I said that formula will be used when the history of dividend payments are given across all relevant years. But the second formula, which is N into square root latest dividend divided by dividend paid in the first year, all minus 1. The second one should be used when the information on the first year dividend paid and the current year dividend are given. All right. But in this particular question, the history of dividend payment from 2011 up to 2015 was given across all relevant years. Therefore, this should be N minus 1 divided by latest dividend divided by dividend paid in the first year, all minus 1, okay, which is equal to N from 2011 to 2015. How many years? Please talk to me. Let me look for partner. I don't want everybody to be talking. I need a partner for this particular question. Yes. Tony, be my partner. I want you to be supplying me figure for this particular question. Tony, are you there? Anthony. Okay. Let me look for another person.
Yes, I'm here.
Okay. Please, I need you to be supplying me figures. So from 2011 to 2015, how many years do we have there?
About 5 years.
5 years. Okay. So that means our N is equal to 5. So here will be 5 minus 1 into square root. Okay, into square root. LD simply means latest dividend or the current year dividend. The current year is 2015. Dividend of 2015 is how much?
Yes, 620.
2015 dividend.
Okay, that's 810.
810.
Okay, 810,000 divided by dividend in the first year.
620.
620. All minus 1. Okay. Therefore, G is equal to 4 divided by 810, into square root 810 divided by 620, all minus 1. All right. So mathematically, I can say G equal to 810 divided by 620 raised to power 1 over 4, all minus 1. All right. So the 4 you have here, you take it to the power of what you have inside the square root. Like I explained to you when I was doing the normal, when we were dissecting the concept, I said G is the same thing as whether you write this formula, whether you use this formula, you can convert it. Okay, you can convert it to LD divided by BD. Let me write it somewhere, not the same place. So you can say G equal to LD divided by BD raised to power 1 over N. All right. So if, for example, like in this case now, so you can't just say 1 over N. You need to first of all minus 1. Okay, you need to minus 1 from the from the number of years dividend is paid before you apply it, before you apply this same formula here. All right. But if it's the second formula you want to use that doesn't have 1 minus n minus 1, only n, then you can use it. So that's just by the way. Now, so mathematically, I can then say I don't need to be using step by step. It's a waste of time. So I will just carry my calculator. I know that 1 divided by 4 is 0.25. I know 1 divided by 4 is 0.25. Therefore, I can say 810 divided by 620 equal. Then whatever I have in my calculator raised to power 0.2, so 0.25 equal minus 1 equal multiply by 100% equal to 6.91. So growth is 6.91%. Here is 6.9%. So approximately growth rate is 7%. Okay, so that's that. Now that I've calculated the growth rates, so I need to go up there for my formula and calculate the cost of equity. Okay. All right, so I said cost of equity is the current dividend into 1 plus the growth rate, all right, divided by XDIV, X dividend share price, plus the growth rate. All of this multiplied by 100 over 1. This is the formula for calculating the cost of equity. Therefore, KE. Now, at this level, I can decide to use par value or I use absolute value. Whether I use par value or absolute value, I'm still going to get the same answer. Why am I saying this? In the question, the dividend given to you is absolute value. The current dividend is 810,000, but the XD share price is par value. It's not total value. Therefore, I need to convert one to so that I'm using apple for apple. If I want to use absolute, let's even try the two. So let's start with absolute value to save time. So the current dividend, DO is the current dividend. The current year is 2015. Dividend of 2015 is 810,000. All right, 810,000 multiplied by growth rate is 7% that we calculated. 7% plus 1 will give us 1.07 divided by XDIV share price. So I need to calculate total market value of equity. So let me go and do my working again. Working number 2. First thing first, I want to calculate dividend per share. Since I'm not given dividend per share, DPS. So dividend per share is calculated as total dividend divided by number of shares. Total dividend is 810,000. Number of shares, according to the question, let's check. What's number of shares in the balance sheet? So we are given 3 million shares. Please, you don't use authorized shares. There is a difference between authorized and issue shares. So your focus is on the issue shares. All right. So which is 3 million shares? So 3 million shares equal 810 divided by 3,000. Okay, 3,000. That's 27 kobo. Dividend per share is 27 kobo. All right. So after this, I need to calculate. Market value. Working number 3. I want to calculate market value. This is total market value. Market value of equity is calculated as, since I'm given number of shares in the question, so I will say number of shares multiplied by XDIV share price. So equity value equal to 3 million shares. So let's go back to the question. What's the XDIV share price? According to the question, you are told that the market value of equity PLC ordinary shares is 3 naira 27 kobo per share, cum div. Pay attention. Again, if you missed the first class when I was explaining cost of equity, you can see now the share price of 3 naira 27 kobo is cum div. You don't use cum div to calculate cost of equity. It has to be XDIV share price. Therefore, we need to convert the cum div to XDIV share price. So let me move to working number 4 for me to be able to do that. Working number 4, let me do it this way. Let me give more space. Working number 4. So I want to calculate XDIV share price. So now I told you that XDIV share price is cum div share price minus the current dividend. Cum div share price of 3 naira 27 kobo. You know, cum div is the share price that include dividend. So you less the current dividend. The current dividend per share we calculated is 27 kobo, 0.27. Minus that will give us 3. 3 naira is the XDIV share price. So now that I have the XDIV share price, I can then proceed to calculate the market value. 3 naira. Okay, so this will give us 9 million. 9 million naira is the market value of equity. So let's complete working for market value once and for all. We also have 7% debenture. Therefore, market value of debenture is the nominal value multiplied by X int price divided by 100 naira. Okay, so D equal to, I will go back to the balance sheet, capital structure. What's the nominal value of the debenture? The 7% debenture is 1.3 million naira, 1,300. Okay, so that's the nominal value. 1,300,000 multiplied by X int price. Let's go to the question. What's the X int price? According to the question, we are told that the debenture are redeemable at par in 10 years' time. Their current market value is 77.10%. Forget about the percentage. So the current market value of the debenture is 77 naira 10 kobo. So if that is the case, examiner told us that the debenture interest, the annual interest has just been paid. So that means that 77.10 is already X int price. So here is 77.10 divided by 100 naira. So what do you have here? All right. So I will say 0.771 multiplied by 1,300 or 1.3 million equal 1,02,300 naira. 1,02,300. So total market value The total market value will then be, because of space, let me just manage total market value. That is equity plus debt. So this will be equal to 10,02,300 naira. Okay, so that's that. Now that we have calculated the total market value of equity to be 9 million, okay, so let's go ahead and complete our cost of equity. You can see the way I abandoned the calculation of cost of equity for like 5 minutes ago. So because I can't proceed, I need to go and make proper adjustments. All right, before I'll be able to use the the variables I'm looking for. So I've calculated total value because here I'm using absolute value. So the market value of equity is 9 million naira. Okay, I think that's working number 3. You can check out working number 3. Then plus the growth rate of 7% multiplied by 100/1. All right, so what do you have here? Let's bring out the calculator. Yeah, 810,000 multiplied by 1.07 equal divided by 9 million equal plus 0.07 equal multiplied by 100 equal 16.63%. This is 16.63%. So cost of equity is 16.63%. Then step number 2, I need to calculate cost of debenture. Calculating cost of what kind of debenture is this one? Is it a redeemable debenture or irredeemable debenture? And I told you that debts will be redeemable if the redemption date or maturity date is given. In this particular question, examiner told you that the debenture will be redeemed at par. Okay, where is that again? Yes, the debenture are redeemable at par in 10 years' time. So maturity date is in 10 years' time. So since we are given maturity date, that means it's a redeemable debenture. Okay, so cost of redeemable debenture. What's wrong with you? Redeemable debenture. Okay. Be careful. You this pen. What's wrong with you? You're wasting my time. Okay. Cost of redeemable debenture. And I explained when we were discussing the concept of cost of debt, I mentioned that redeemable debenture is calculated as internal rate of return. What are you supposed to do? There are 2 steps. Step 1, you assume 2 discount rate that will produce 2 opposing NPV. Step 2, you calculate the internal rate of return using IRR formula. Whatever you have thereafter will represent your cost of redeemable debts. Okay, so if that is the case, I would then say assume 10%. When you are calculating internal rate of return, examiner will not give to you the discount rate. You are the one that will assume it. And that's why we said IRR is subjective. So you are the one that will assume the discount rate. So if that is the case, I would then say, I want to calculate NPV. So I will create a column for year, description of items, cash flow, discount factor, then I have the present value. Okay. All right. So we have year 0. The maturity date of this debenture is in 10 years' time. So which means that the company will pay annual fixed interest from year 1 up to year 10. The interest is fixed, it's constant. Therefore, I will calculate annuity factor from year 1 to 10. Here is the current market value. Here is the fixed interest. Then at the final year, which is year 10, the company will redeem the preference share, the debenture will be redeemed. How are we going to redeem the debenture? We are told it will be redeemed at par. So redemption value. So that's it. So we are using only one table to calculate the two NPVs. Okay. All right. So this will be my NPV. We are starting from 10%. So I will go back to the question under cash flow. Under cash flow, what would be my current market value of the debenture? According to the question, we are told that, yes, we are told that the debenture, their current market value, let me start from the debenture. The debenture are redeemable at par in 10 years' time. Their current market value is 77.10. Annual interest has just been paid. So since interest has been paid, I don't need to worry myself. No adjustment is needed. So here will be equal to 77.10. So I don't need to make any adjustment because debenture interest has just been paid. Augusta, please mute. Augusta, thank you. Now, for the fixed interest, pay attention. You know, all those concepts we have explained previously is what we are applying now. So, for the fixed interest, I will go back to the question, what's the coupon rate on the debenture? You are given, examiner, you are told that this is a 7% debenture. So, the coupon rate, the interest rate is 7%. Am I given tax rate in the question? Yes, examiner has given us tax of 30%. How am I going to pay the tax? Is it in the current year or in arrears? Examiner is silent. You are not told whether it is in current year or in arrears. So you are going to assume that tax will be paid in the current year. So that one, there is no issue. So I need to go and adjust for after tax interest. So instead of me to put 7 here, I cannot use 7 because I'm given tax rates. So I need to go and adjust for tax. So let's go and do the working. We want to calculate post-tax interest. You see the way we are flowing? That's what is expected of you.
Sir,
Working
I have a
number.
question.
I've told you severally, when you want to ask me a question, you raise your hand.
Okay, sorry,
Don't
sir.
disrupt. Let me finish this one, then you ask the question. Then I want to calculate post-tax interest. Okay. Post-tax interest is calculated as interest multiplied by 1 minus tax rate. The interest rate given to us is 7. Tax rate is 30%, 1 minus 0.30. Therefore, 7 multiplied by 0.7 will give us 4.9. So instead of me to use 7, I'm going to use 4.9. That 4.9 is after tax interest. So I will then come here, 4.9. Okay. Yes. Somebody was talking the other time. What's his name? Please go ahead.
Sir, you said the examiner
Okay.
might
Zoom
say
user,
something
please
like,
remind me of your name.
sir,
What's the name?
the name is Kevin, sir.
Femi.
Kevin.
Kevin. Oh, you are Kevin. Oh, yeah. Okay, go ahead.
Okay, you said the tax that they might say the tax is paid in arrears.
Yes, or in the current year.
And if it's paid in arrears, how is you going to solve it?
It's very simple now. So, say for example, like here now that I want to calculate annuity factor of year 1 to 10. So, if tax is paid in arrears, that means there's 1 year lag. Instead of you to start from year 1, you are going to add additional 1 year because you are not paying it in the current year. In this case, it will be year 2 to 11. If, for example, the maturity date is for 5 years and you are told that tax is paid in arrears, so in this case, it will be year 2 to 6. So there's always be, once there's 1 year lag, so you cannot start from year 1. You are supposed to start from year 2. So that will extend the maturity by just 1 because of tax purposes. All right, no worry. You are going to see how we are going to treat it when we get to, there is a specific question we are going to solve on that. All right, Kevin? Kevin, is it clear?
Oh, sir. That is all, sir. Thank you, sir.
All right, then you are welcome. So, in the final year, which is year 10, this debenture will be redeemed. How are we going to redeem it? Examiner told us that it will be redeemed at par. At par means at 100 naira. Remember, debt is always quoted at 100 naira per unit. So here will be 100. So at this point, I need to calculate annuity factor of year 1 to 10 at 10%. Okay, so here is 1. So somebody should give me annuity factor of year 1 to 10 at 10%. Quickly.
6.145.
6.145. Thank you. Then I need a discount factor of year 10 at 10%. Discount factor
0.386.
0.386. Thank you. So in this case, 77.1 multiplied by 1 will give us 77.1. Then 4.9 multiplied by 6.145. What do you have?
30.1.
30.1. Here is 30. Let me rewrite it. 30.10. Then 100 multiplied by 0.386 will then give us 38.60.
8.6.
So 38.60 plus 30.10, that's 68.7 minus 77.1. What do we have?
Minus 8.4.
8.4, right?
8.4, that's it.
Okay. No. This is it 8.4? This is 68.7. Yeah. So it's minus 8.4, right?
Yes, sir.
Okay. Then we assume 10%. We got a negative NPV of 8.4. Let's assume a lower discount rate that will produce a positive NPV. So I would then say 5%. So let's calculate annuity factor of year 1 to 10 at 5%. Give it to me. Minister of Finance, I'm coming for you. Annuity factor, year 1 to 10 at 5%. Somebody else should calculate discount factor of year 10 at 5%.
7.721.
7.721.
2. Approximately.
722.
Yes, sir.
Okay. Then discount factor of year 10 at 5%.
0.614.
614. Okay, thank you. So, Minister of Finance, go ahead.
Like, do you know that when I finished calculating NPV that gave me negative, I was stuck, like how to recall that if
10 gives you positive, I'll be negative. Increase it or reduce it. I was just waiting for you to make that statement.
Comment.
Yes.
Okay.
So I
Now
don't
you
know, like,
understand, right?
what's the easier way to recall this thing fast? Like, I didn't have to wait for you to say that thing before I.
Like I said, once you assume the first discount rate, if the discount rate gives, for example, you assume 15% to calculate NPV, and that discount rate gives you a negative NPV, for example, so you reduce it to get a positive. If the first discount rate you assume give you a positive NPV, you increase it to get a negative. That's all you need to do. All right?
Thank you, sir.
You're welcome. So let's multiply 4.9 multiplied by 7.722. Quickly. Our time is flying.
37.84.
37.8.84. Yes, this one will then be 61.4. 61.40. So 61.4 plus 37.84 equal minus 77.10 equal. Give it to me. What's the final answer?
22.14.
22.14. So that's the NPV. So we assume 10%, we got a negative NPV of 8.4. We reduce it to 5%, we got a positive NPV of 22.14. Now that we have two opposing NPV, we can then proceed to calculate cost of redeemable debenture, which is KD, that is internal rate of return, will be calculated as the lower discount rate plus the NPV of the lower discount rate divided by NPV of the lower discount rate plus NPV of the higher discount rate. All of this multiplied by higher discount rate minus lower discount rate. Okay? So A is the lower discount rate. 5% is lower than 10, so here will be 5 plus NPV of the 5 is 22.14 divided by 22.14 plus NPV of the higher 8.40. So higher discount rate of 10 minus lower discount rate of 5. Final answer, give it to me. You start from the denominator, 22.14 plus 8.4 equal, then 22.14 divided by answer equal, multiply by difference between 10 and 5 equal, then plus 5. Final answer, give it to me.
9%.
Pardon? Yes. What's the final answer? 8.4. That gives 30.54. So 22.14 divided
8.6%.
by 30.14 equal, multiply by 5 equal, plus 5 equal. That's 8.67. Here is 8.67%. So the cost of redeemable debenture is 8.67. So step 3 is to calculate WACC. Calculating WACC. KW. So to do this, I would then say KW WACC equal to equity value divided by equity plus debt multiplied by cost of equity plus debt value divided by equity plus debt multiplied by cost of debt 1 minus tax. All of that you multiply with 100%. So the WACC will then be equal to, we've already calculated market value of equity. You can see in this question, examiner did not ask you to use market value to calculate your WACC. So it is implied in the question. You only use book value to calculate weighted average cost of capital if examiner asks you. Once you are not told, just go ahead to use your book to use your market value. So market value of equity, we calculated 9 million. Here is 9 million divided by the total market value is 10 million, 2,300 naira. Then multiply by cost of equity. We have calculated cost of equity to be 16.63%. Okay, so here is 16.63% on one side, then plus the market value of the debenture is 1,02,300 naira. This is it, 1,02,300. Okay, so here is 1,02,300 divided by total value. Total value is 10,02,300 multiplied by after-tax cost of debt. The after-tax cost of debt we calculated 8.67%. 8.67%. So there is no need for you to adjust for tax. We've already adjusted for tax. One of you asked me the other time when we calculated the first question. When we solved the first question, one of you asked that if I'm using market value, or if I'm using the tabular method to calculate my WACC, how do I adjust for tax? I mentioned to you that time that when you are calculating the cost of debt, you would have adjusted for tax before you get to using the table. You will see that we've already adjusted for tax when we calculated the post-tax interest. Okay, this post-tax interest here, we've already adjusted for tax. All right, so which means that the cost of debt we have calculated is already after tax. This cost of debt of 8.7, okay, is the after tax because we are using after tax interest, which is 4.9. All right, so where are we? Yes. So WACC is equal to, let's use calculator to do this once and for all. From the left, I will say 9 million divided by 10 million, 2,300 naira equal, okay, multiply by 16.63 equal, that's 14.96%. Here is 14.96% plus the other side. The other side is
0.86.
2,300 divided by 10 million, 2,300 equal, then multiply by 8.67 equal, that's 0.89%. Here is 0.89%. So we add the two together. Then our WACC will then be equal to, I'm coming, Mr. Atlisa. Then I have 14.96 plus 0.89 equal, that 15.86. Is it 0.86 or 0.85? Let me check.
I got 0.82.
15.85. So the WACC is approximately 16%. Okay, the WACC of equity PLC is approximately 16%. So add these two together, that's what you are going to get. 6 plus 9, that will give you 5. So yes, Mr. Tlisa, go ahead. You raise hand.
Sorry, sir.
Yes.
Observation from this cost of redeemable debt. I calculate
Okay.
give me 8.62 instead of 67.
You get what?
8.62 instead of
8 point.
6. I don't know, maybe
Okay.
my own.
Yes, it's correct. 8.62.
Let's do it together again. Let's do it together. We are starting from the denominator, right? 22.14 plus 8.4. Okay. That gives 30.54. So 22.14 divided by 30.54. Okay, equal. Then multiply by difference between 10 and 5, which is 5. Equal. Then plus 5. Equal. Oh, that's 8.62. This is supposed to be 8.62. Thank you. All right. So here will be 8.62. So 8.62, let me see. From the calculator, 8.62, okay. 1,02,300 divided by 10,02,300 equal, then 8.62 equal, that's 0.86, that's 0.86, okay, 0.86. So 0.86 plus 14.96 equal to 15.82. All right, thank you. 15.82 is the final answer, approximately 16. All right, so that is that. That is that. You can see all the stress we have to go through for us to be able to calculate work. Now, in this, I did not, I forgot to demonstrate that for you. You know, when we calculated our cost of equity, we used absolute value. So I did not demonstrate how to use the power value instead of absolute value. So quickly, let me see, can I use this small space? Let me see if I can manage this small space to do that. So if I want to use power value to calculate it, it's the same thing. Cost of equity will then be equal to, I've already calculated dividend per share to be 0.27, to be 27 kobo. Let's see from my working. All right, dividend per share is 27 kobo. That's it there. Then growth rate is 7%. Okay. So I just want to demonstrate for you that whether you use power value or you use absolute value, you get the same thing. So here is 0.27 multiplied by 1 plus 1 plus growth rate, which is 1.07, then divided by SDIV share price. We have calculated SDIV share price to be 3 naira. All right. Then plus the growth rate of 0.07. That page is too short. It will cut off. Let me reduce it. KE equal to 0.27 multiplied by 1.07 divided by 3 naira plus 0.07. Okay, all multiplied by 100%. Okay, so your KE should be the same thing. Let's see. 0.27 multiplied by 1.07 equal divided by 3 equal plus 0.07 equal, then multiply by 100%. So 16.63. So whether you use total absolute value or you use power value, you're expected to get the same answer. Okay, so that's that. That's that. So that's the end of the question. Let me know if you have any question for me so that we can't solve additional question again. The time is fast spent. So in our next class, we do 2 more illustration under this, under work, before we move to project-specific work. All right. So let me know if you have any question for me, please. Any question? Somebody is sending something. Okay. Minister of Finance, 8.62. Thank you. We've resolved that. Okay. So in the absence of no further question, this is where we are going to call it a day. Like I said, in our next class, we are going to solve 2 more additional illustration under this. Then thereafter, we move to project-specific cost of capital. So go ahead, go and read about project-specific cost of capital. So because I will introduce you to it on that day, because if I can spend like 1 hour or maybe 1 hour, 20 minutes to solve the remaining 2 questions, then I can spend the remaining hours on project-specific. All right. So give and take. Let's say we have 2 more periods to be able to complete cost of capital. So thank you, everyone. I will see you next time by the grace of God. Bye-bye.